Welcome back, Apple business magicians. Ever wondered how accountants keep thousands of transactions from turning into a mushy fruit salad? Two magic words: double entry. We have already briefly touched upon it, keeping our balance sheet balancing and connecting it to the income statement. Today, we will look into the concept of a double entry in a bit more detailed way. Double entry means every business event records two equal amounts, and these amounts are often shown across each other. One is on the left side of an account and one on the right side of another or the same account. The one on the left is called debit and the one on the right is called credit. They are abbreviated as DR and CR. You will see this a lot in any accounting manual. Total debits must always equal total credits, so the books stay balanced. And to visually simplify it, they are normally recorded in the table which reminds a giant letter T. That's why it is also called T accounting. A lot of people find this way of presenting double entries convenient and easy to follow. It looks like this. On the left we put debit, on the right credit. Each account, cash, inventory, receivables, bank loans, etc. gets its own T. Normally the accounts will look like this. On the balance sheet, increase in assets will mean debit. Increase in liabilities and equity will mean credits. For the income statement, it may look confusing. Revenue will be recorded as credit and expenses as debit. And I know that intuitively we think of debits as a good, positive thing, which results in an increase in assets. But for the income statement, it's the opposite. Just remember, revenue credit, expenses debit. You will see in a bit why. Let's put the numbers on the screen and start by injecting $1,000 of cash into our Apple business. Earlier we saw it like this: $1,000 in cash and $1,000 in equity on the balance sheet. In the T accounts world it will look like this. T account for cash, debit on the left side, $1,000. T account for equity, credit on the other side, to the right, $1,000. You see that debits equal credits, books are balanced. Now let's buy 30 apples for $10 each. For that we spent $300 in cash. Decrease in cash means credit entry. We now put $300 on the right side of the T account for cash. But we get apples instead. So we set up a T account for inventory and record inventory there, on the left, as a debit. $300 of apples. Now let's sell half of our apples, 15 apples for $20 each, on a 30-day term, on credit. What happens now? We need to record revenue and trade receivables. We set up T accounts for them. Accounts receivable, increase in assets, debit on the left, $300. And sales revenue. To balance the left side and debit from accounts receivable, we record sales on the right, as credit, $300. Now to our apples. We need to remove them from inventory to cost of sales. So we decrease inventory. Means credit and the right side. 15 apples, $10 each, $150. For cost of sales, we need to balance this $150 on the credit side. So we record cost on the left as debit. So you see now why revenue is credit and costs are debit, to balance everything. Let's double check. What we have on debits: $300 for receivables and $150 for costs, equals $450. And on credits, $300 for revenue and $150 for inventory, also $450. It balances. Now the customer pays the invoice. Cash account, debit $300. Receivables are removed, credit $300. Receivables are cleared, cash increases, the balance sheet flips but totals stay equal. Let's also pay some rent, $50. Cash, credit $50. Rent expense, a new T account, debit $50. Expense increases on debit side, cash decreases on credit side. Let's add up each T. Cash, initial $1,000 plus debit $300 from sales, less credit of $300 for buying apples, and less $50 from paying rent, $950 as a result. Inventory, $300 of apples bought and $150 sold, $150 left. Receivables settled, 0. Let's move entered asset and liability balances to the balance sheet. it will look like this. And it doesn't balance yet, but no worries, just a moment. Now let's move total revenue and expenses into P&L. It will look like this. From the revenue of 300 and cost of sales 150 and rent of 50, we get a profit of 100. And where do profits belong to? Correct, to equity. We move it to equity in the balance sheet, and balance sheet balances. You can of course set up a T account for equity too. And before we publish financial statements, we list every ending T account together in a so-called trial balance. Debits must equal credits, and they do in our case. If not, we go back to detective work. Why do beginners love T accounts? They are visual, you literally see the two sides. They prevent one-sided errors. And they make translating transactions into statements painless. What are the common mistakes? Debiting revenue or crediting expenses. Flip them. Forgetting the second entry entirely. Confusing paying a liability, which would be credit cash and debit liability, with creating a new one. Now let's briefly summarize it. Double entry means every event hits two sides. Debits raise assets and expenses, credits raise liabilities, equity and revenue. T accounts are your training wheels. Master them and full ledgers will feel easy. Congrats, you can now decode the secret handshake of accounting. And hit like, subscribe and ring the bell so you won't miss the next lesson. See you soon and keep those debits equal to your credits.